Well, good Sunday morning, everybody. This is Dave coming to you from the paddock here in Southern Maryland. We are back for another investing session. I believe we're in session number 6 officially. I put up that little bonus thing about people making stupid decisions to buy toys when they could and should be doing investments. So but I didn't number that. So, guys, we are advanced into the high risk area. This is picking individual stocks. So we are here today. We'll talk about that in a minute. So I'm here in the paddock. It's about 8 o'clock Sunday morning. I'm in early because I had to take Anne-Marie to the airport up in DC. She flies out of National. Going down to Sarasota to see Lauren for Lauren's spring break, which started yesterday. So it's good. My girls get to spend some time together. They're both excited about it. And that means I'm a bachelor. So I got to get out of here early today. I got hookers coming over starting around noon. Kegs get delivered a little after that. So it's going to be a big afternoon for me. Kidding. Joke. I go to bed early. Okay. So before we start the session, the first thing you should do is go watch the movie Wall Street. Get all fired up. It's a great movie. I love it. The greatest lines, one of the best speeches is the greed speech. You should know it. If you haven't seen the movie, I consider that a character flaw. Please fix that today. And the greed speech. Greed is good in all its forms. It's a great speech. And then when it's done, say to yourself, I am not, and I will never be Gordon Gekko. All right? We're not going to buy companies and wreck them because they're wreckable. All right? We're not going to file 1090Ds forms because we're going over 10% of ownership in any company, okay? So it's a great movie, great entertainment. It has nothing to do with stocks, okay? Pure entertainment, but it's fun. Another one you should go watch is The Wolf of Wall Street. Fabulous movie. That's where the hooker reference came from, by the way. So if you haven't seen it, that's another character flaw. It's not wife friendly. At least in my house, it's not wife friendly. It's a great movie, though. Just because it's not wife friendly doesn't mean it's not a great movie. In fact, because it's not a wife movie might mean it's a good movie. What am I smoking while I put this together? Back to the Mark Marilyn Meerschaum. So a couple of you guys are asking, hey, have I picked my new Marilyn Meerschaum yet? And the answer is no. Currently, I've got 2 in the running. The one I had yesterday, it's just this nicely fancy Meerschaum with the Churchwarden stem on it, and then the Mark Meerschaum. These are the ones that are kind of competing with each other for the one I'm going to smoke the most. So we'll see. But today it's the Mark Marilyn Meerschaum. And what's in it? I'm still using Brown Irish X. The reason is I did a good triple rub out there, like Uncle Willie teaches us, and I had a couple bowls left over. So I'm going to start with this, and then I'll move to something else while we make this video. Thank you, Greg. So we have a bunch of concepts to get through. We're going to be talking about the different kinds of stocks out there. We're going to talk about the different kinds of analyses out here, the things you look for, the phrases you'll hear if you watch these stupid stock shows. Kramer's money shows, one of them you probably shouldn't watch. In fact, there's not a money show out there that I would recommend you watch. Those are entertainment. Those are meant to drive you in bad directions. I don't watch any stock shows. I don't know anybody who invests who really does. Except maybe to see what the sheeple are doing. I'll show you how fancy I am. I brewed my cowboy coffee at home and brought it here in my thermos. Look at this old man thermos, huh? That's toxic masculinity right there. Big old steel thermos. I've had that thing for 30 or 40 years. So guys, kind of the grandfather of stock investing or company investing is Warren Buffett. Hopefully you've heard the name. No relation to Jimmy Buffett, by the way. Lots of stories about that, but they were not related in any way. Warren Buffett doesn't recommend buying individual stocks. He, as the chair of Berkshire Hathaway, that's his company, likes to buy companies, not stock in public companies. Sometimes he buys companies on the public market and then takes them private. I believe he only owns stock in two companies, Coke and American Express. There's a couple books. So his right-hand man, Charlie Munger, died this year at 100 years old, I believe. And Warren himself is in his 90s. So this guy as an asset will not be around much longer, in my opinion. So I have 3 reading recommendations. One is sort of a must, and the other 2 are interesting. The interesting one are books. There was a books written by Charlie Munger are fun to read, and they're hard-hitting. He wrote a book 40 years ago, Damn Right. That was a good book. I enjoyed that. And then there's one by Warren Buffett, Snowball, which is the story of his life and how he got into investing. It's a good read. So I know some of you aren't book readers. I wish I could reach through the camera and shake you. If you're not a reader, start. If you're going to throw, I'm dyslexic or reading is hard for me, or whatever, blah, blah, blah. Not reading is bad. Okay? You really need to learn to read. So anyway, Charlie Munger's Damn Right and Warren Buffett's Snowball are 2 books that I recommend you read. So the one you really almost have to read is Warren Buffett's annual letter to the shareholders of Berkshire Hathaway. He makes it public, and there's a website, and I'm going to show it to you. There's a website where you can go back and read all of them, and it talks about where he thinks the market's been, where he thinks the market is going, and how he's positioning Berkshire Hathaway. It's a monster entity at this point. How he's positioning it, what he's looking at buying, what he's buying, what he has bought that's worked, what he has bought that hasn't worked. It's a really good, fairly quick read every year. It's 10 pages a year. It's nothing for you to invest the time and understand where probably the world's greatest investor thinks the world is going. Okay, guys, I'm just follow right up on that. So here's berkshirehathaway.com/letters. Here's how it comes up. You can see, you can go all the way back to 1977. I've read all of these. If you read his letter to shareholders from last year, this year's hasn't come out yet. You see it comes up. And he does, Charlie Munger just died back in November, so he does this whole remembering. But then he gets in here and to the shareholders of Berkshire Hathaway. Let me see. Including appendices, the whole thing is 17 pages long. And it's always important to him to compare himself to the S&P 500. So he compares every year the performance of his company, which is on the left, right here. How his stock did that year versus how the stock did in the S&P 500. And you can see that from 1977 to now, the Dow Jones has gone up 31,000%, and Berkshire Hathaway has gone up 4,384,000%. Not a joke. So then I want to show you the stock value of Berkshire Hathaway and what it's done lately. And down here is he shows, this website shows you from in 1981 you could have bought Berkshire Hathaway for $493 a share. And then I brought it up on the charts. This is a current chart of it, and you can see its valuation. To buy one share of stock in Berkshire Hathaway is $613,965. That's crazy. So to not learn this man, to not understand how he does things as a foundation to your individual stock investment methodology, I think is not wise. So guys, I've put this in the high risk zone, the red zone. The reason I do is it carries all the risks of the yellow zone, meaning it's market driven. Once you've moved your funds into an investment platform and then purchased a stock in your investment system, you've lost all control of it at that point. You can only sell it. You can either add more or sell, right? So the market drives the value of the stock of the company that you've decided to purchase. So that's medium risk. But I moved it to high risk because you could pick the wrong stock, right? You could suck at picking stocks. And most people do. And so I want to go back and remind you from a couple videos ago that Warren Buffett's recommendation to his family was, if he passes away, to take their funds and put it into an S&P ETF fund. That's his formal recommendation to his heirs. The greatest investor in the history of investing, in my opinion, is telling his family, those closest to him, when I'm gone, get out of this business, put all your money into an S&P ETF. All right? I just want to make sure. That's why this is red. You're carrying market risk, and now you're carrying your own personal ability to do this kind of analysis. I don't do this. I don't try to pick individual stocks. I don't know the market well enough. You need a really long runway to be wrong, right? If you're wrong, the stock will most likely recover, but it could take years to recover. So you need to have a runway, right? This is length of life you have left, length of time you'll need this money. So you need potentially years. It's almost like real estate. You could get out of it. You can sell stock in a second on your platform, so you can get your money back. So it's not an access to funds issue like it is with real estate, but it's access to how much of your money, right? If it's gone down 20% and you need your money, that means you're going to be selling. And this is where God has a sense of humor, guys. If he knows you need your money, he'll probably drop you 20%. It's crazy how the world conspires against us on time frame when we just get ourselves in a position that we need money. So the money you put into individual stock investing is money, simply stated, is money you don't need. It's money that could sit out there in the investment world for years, and you see nothing in your future that you're going to want to take that money for, right? This is long-term thinking now. So guys, I want to introduce you to another online free resource, Investopedia. It's a great place to come and learn basic stuff. Now it's free, so you're going to get a lot of pop-ups and marketing, but that doesn't make it bad. There are two types of analyses when we go to look at stocks to purchase: fundamental analysis and technical analysis. And I just want to show you how Investopedia, defines fundamental analysis. Here it says right here, analysts typically study the overall state of the economy, the strength of the industry that the stock resides in, and the financial performance of the company that you're looking at. So 3 analysis: macroeconomics, industry economics, and then the individual company's performance. So again, Investopedia, I go there when I just need to learn the definition of a term, or I want to see how a strategy gets laid out. Anything I do with investing, I usually start answering my own questions on Investopedia. So I wanted you to see that. I also want to talk about free services, whether it be Facebook or Instagram or Investopedia or anything. When you sign up for the free account, usually you end up being the product. They'll scrape your info and they'll probably sell it. You have to agree to the cookies that come with the site. That's not all bad. Just know that when you are on a free service, I don't care what it is, unless it's an individual who says, I won't sell your data. I think Lynn Alden is an example. You can sign up for her free service, and I don't think you're going to catch a lot of marketing from her. I can't say that about Investopedia or Facebook or anybody else. Your data is probably being sold to marketers, and so just be aware of that. Any free service, you're the product. So guys, fundamental analysis is basically, is the company a good company or not, okay? Is Walmart a good company? Is Apple a good company? Is Intel a good company? And that takes real work. You have to read quarterly reports, annual reports. Is the company making money? Is it making profit? Does it have a growing revenue, top line, bottom line? Did it beat the market expectation, the analyst's expectation top line, which means they beat on revenue, but they didn't make the profit that was expected, so they missed. You'll hear things like they beat analysts' expectations this quarter. That means they probably exceeded their top line and bottom line, so their revenue or their sales and their profit both exceeded expectations. That's what you like to hear if you're going to buy a stock, right? So to call that even scratching the surface is idiotic, but I just want you to understand there's fundamental analysis and there's technical analysis. So what is technical analysis? Technical analysis is all that sexy charty stuff like what's right here. We're gonna go over and talk about this screen in a minute. But this is where you start hearing about indicators, okay? Moving averages, MACD, RSI. I mean, it gets gobbledygooky really, really quick. And you just need to understand that you got to go learn these terms if you choose to go down the individual stock route. So we're going to do that right now. We're going to go over and I'm going to show you kind of what I use on my charts. Remember, I don't do individual stock. I do futures, but it's the same technical analysis, so it makes it easy for me to show you what I use, which does not make it right. It does not make what I use what you should use, but it makes it a hell of a lot easier to talk some basic examples of technical analysis. Now, like Investopedia, they have a technical analysis academy. So if you wish to do it, you can go spend some time, and there's some great resources out there on how to learn what is technical analysis and how to do it. So let's go to the chart for a minute and we'll talk about one real world example. Okay, guys, this is that screen that it was behind me, and I just want to show you. So we are looking at Apple, which is AAPL is their stock ticker symbol. What you're looking at is a weekly chart. So every one of these green and red bars represents a week of performance of the stock price. You're looking at about 3 years of history. And you'll see on here, so these are candlesticks, and there's about 10 different ways you can have these shown. So I have up days are green, down days are red, and then the stock price during our weeks. You can have any time frame you want. I can change this to a daily chart, which is what I use, but I wanted to show you a weekly chart for Apple. So we can switch to daily since I just said I use daily. All right, guys, so right here, this is my daily. That's how you know it's daily. See that these are green are up days, red are down days. You can see it's about a year. Yeah, it's about a year's worth of history here. So what you see on my chart, on my price chart, you see moving averages. So this is the 200-day moving average of the stock, and you can see it's moving up. You can see this is my 50-day and my 20-day. So over the course of the last 50 days, how's it looking? That's what this purple line is. And over the last 20 days, how does that stock look? And you can see over the last 20 days, it's been tailing off. So the 20 is turned down, the 50 is turned down. You can see that the 20 days about to cross below the 200-day. That's considered not good or bearish. Anyway, so moving averages, that's what you see here. Okay, and then down below, I've got two other indicators. This is the MACD, the moving averages, convergence, divergence. When you see this pattern, it's generally positive or bullish. And when you see this pattern, it's generally considered bearish. So if you use technical analysis to time your entry into the purchase of a stock, you want to try to buy it down here and watch it go up. You've got to be careful because remember you're not buying these for days. That's why I had the weekly chart up. You're buying it for long term. So I'm going to go back to the weekly chart. And you can see 200-week average, it's clearly positive. You can see the 50-day is clearly positive and the 20-day is clearly positive, right? I mean, you can look at all these, you can get too into it and look at all these fluctuations, but they call it, what would a 5-year-old say? And they'd say, hey, Dad, the 5-year-old would say, well, it's definitely moving up, right? As we move left to right, it's moving up. A 5-year-old will tell you this stock is in a good trend. Down here is the relative strength indicator. It tells you if a stock is overbought, which this area here will show you right there. That'll show you that the red, that's saying it's overbought and probably going to be headed down. Too many people have bought it. It needs a little price help. Down here, almost, if it gets below this line down here, it turns blue, and that means it's oversold and is probably ready for an increase. Okay, so I don't want to try to teach you a whole lot more about technical analysis. So candlestick formations, price trend, moving average trends, MACD, RSI. If you want to start going down the road of analyzing individual stocks, you do some fundamental analysis about how the company is doing, and then you come in here and look and see how the stock price is doing. All right, guys, so one of the things I've really tried to do on this series, and I've said it several times, is de-lingo the stuff for you so you speak regular English and understand what the hell these things mean. So you need to understand the difference between growth stocks, value stocks, and tech stocks. Those are the three big buzzword lingo words you're going to run into as you read and start to study into this part of the investment world. We're going to go to the screens and we're going to talk about all of those right now. All right, so here's another resource for you, Forbes Advisor, Forbes.com. It's a free, I don't have any accounts, any of this stuff. You can just, this is general over the internet stuff. So there's nothing for you to subscribe to. You just come here and look. So what are growth stocks? What are they? So they are companies that are growing their share prices, revenue, profits, cash flow at faster rates than the market at large. Investors choose growth stocks to earn profits from the rapid price appreciation rather than income from dividends. All right, so that's growth stock. And then value stocks. So growth and value. So here's growth, and we just did growth. Value is the long-term conservative approach. When you invest in value stocks, you're looking to buy and hold companies whose shares price is currently lower than their intrinsic values. So value investing along growth investing are the two basic strategies investors choose, okay? Value stocks tend to gradually gain in price over time and hold their value long term. Meanwhile, growth stocks tend to be more volatile with share prices that fluctuate rapidly over shorter time frames. All right. So some people try a mix of both. They want some steadiness in the value stocks and they want the growth of the growth stocks. Okay, guys, we're still on Forbes. And as of this month, March 2024, Forbes is saying these are the top 10 growth stocks to get involved in. And they actually give their 5-year average growth of their stocks. And so you have, I don't know these companies, the Vita Coco Company, NVIDIA is, I'm saying we know that one. Live Nation Entertainment, Insulet Corp, Full Truck Alliance, WillScot Mobile, Yelp, Skechers, T-Mobile, and Meta. Meta's Facebook, in case you don't know that. All right, so that's Forbes thoughts. So there's 10 examples of growth stocks. Okay, and we're still in Forbes, and they're saying the 10 best value stocks as of this month. Now listen here, and you can just tell: Graphic Packaging Holdings, Lear, ACM, LKG, Webster, Bank, Oz, I have no idea, T-Mobile US, Autolive, Lamb Weston, and Darling Ingredients. So you can tell they're really much different. These are, sometimes you'll see like Walmart in here. So just, these are way less sexy companies. They don't even show you the percentages here. I don't know why they give us PEG ratios, whatever. But anyway, so now you have 10 examples of value stocks. So you have 10 growth and 10 value. You now understand the basic difference between the difference between growth companies and value companies. All right, guys, so we've talked now through fundamental analysis, technical analysis. We've talked about growth stocks. We've talked about value stocks, and we need to talk about high tech because this is the sexy part of investing, and it's probably the sector I would move money into if I were to buy individual stocks. I just think the world is getting more and more tech. You may or may not like that, but that's not the point, right? With our move towards artificial intelligence and higher end processors and more data storage, these are not positives for the team freedom here, but this is where the world's headed. So, one thing that I would recommend you do is try to disassociate your beliefs and your opinions and your emotions away from the investing part of your life. Because your opinion of Apple, your opinion of iPhones does not matter to the market. So now I'm going to delingo another thing, and that's FANG stocks. You hear that all the time. And if you watch any shows or do any reading, a lot of times you hear about FANG stocks. So we're going to go through that because that really is your entry point into the tech stock world. All right, guys, we're still at Forbes Advisor. I just like how they do some of their writing. So Investopedia and Forbes are the two sources that you got introduced to today. So FANG stocks. FANG is F-A-N-G. The term came about in 2013, so it's 10, 11 years old now. And let's see. So you can see it right here. I'm just going to tell you for a minute. FANG, the old FANG, used to be Facebook, Amazon, Netflix, Google, FANG. Facebook, Amazon, Netflix, and Google. They came along in 2017 and made it FANG with 2 A's, and it became Facebook, Apple, Amazon, Google, and Netflix. All right, so here, right here, Facebook, let me do it right here. So Facebook, Apple, Amazon, Netflix, and Google. All right, now they've changed their names and changed it around a little bit. So now they're calling it Mama, which is kind of stupid, but they didn't ask me. So here you can see what it is. It's Meta, which is what Facebook changed its name to. Amazon, Apple, Netflix, and then Alphabet is Google changed. Alphabet is now the parent company of Google, and they actually have 2 stock tickers. So there you go. And then you can go through here and kind of see the individual stock information for each one of those in the FANG or the Mama. I still hear a lot of people talk about FANG, so I just wanted to delingo that for you. So that's enough of that. So guys, I want to talk to you for a minute now. This is another one of those stop what you're doing, look at me, and listen. The investment world does not want to help you. They want to take your money, okay? The stock markets want to take your money. That's what they're intending to do, right? So it's you against the markets. And so lots of times we turn to things that we think are friendly, and that's buy and sell recommendations. And if you go to any brokerage firm, in fact, there are companies, I'm not even going to show them to you, that aggregate buy and sell recommendations. And so you can see things like, hey, here are the top 10 strong buy recommendations. Here are the top 10 buy recommendations, the top 10 sell recommendations, and the top 10 strong sell recommendations. Those usually you'll see buy, hold, sell. That used to be the old way. Now it's really strong buy, strong sell, hold, sell, strong sell. You'll see 5 ratings again from all the major brokerage firms. You just need to understand that there's some nefarious behavior going on when you see those kind of rankings. So again, you're looking for, if you get out there and see it, you're going to see lots of people talking about, hey, it's a strong buy on Walmart. But so you're looking for strong buy, hold, sell, strong sell. Okay? I'm going to tell you why I don't trust those. All right, brokerage firms. Brokerage firms want to earn your trust. They want to earn your business. They want to earn your account. They want to show you why you should pick them to put your account to when you make these kind of investments. And so they do it by saying, hey, we'll always tell you, what we believe all the strong buys. They might have 50 strong buys. They might have 4. I don't know. It changes every day, changes every week. That's part of the dangerous part, but that's not the nefarious part. Brokerage houses don't care about your account. You're too small to care about, right? So am I. I mean, I'm not trying to personalize it. They don't give a shit about individual accounts. They want corporate accounts. These brokerage houses want to win the business of like IBM's investment portfolio, either for the company itself or for the company employees. Those are the ones they want. Or what they really want are the sovereign wealth funds. So the official investment accounts of countries or of high net worth families. The Heinz family, the Rockefeller, I mean, they don't even play at this level, but the Heinz company, the Marriott family, things like that. Those are the accounts they want. Let's talk about how they use you to obtain those kind of accounts. So let's say they get a call from a major account or one they're trying to woo into their den, and they say, hey, you know what, I can get you into 1 million shares of Apple at 10% below today's market value. And the big account be like, shit, dude, you can do that. I'm going to move my Apple holdings to you. So they put out strong sell. All right. And so all the idiots, all the individuals like us say, oh shit, man, they've moved Apple to a strong sell. I'm going to go ahead and get out before it falls down. And they start selling, which does what? It depresses the price of the stock. And when it hits the point that they promised this other major account, they then apply the giant sell orders and walk the major accounts into the stock at the price they promised they could. Okay? Which, guess what happens to the stock then? It rockets up, and then they switch it to a strong buy. Or they'll walk it up, strong sell to neutral or hold. You'll start seeing them walk it up the ladder, and all of a sudden, a stock that you took their advice on and did a strong sell, wow, I better get out, man, this guy's looking out for me, is all of a sudden moving up and fairly strongly. And they got the major account in the door at the lower price, and then gave that account the benefit of switching their evaluation of the stock. It's just a word, right? From strong sell to strong buy. That's just a change of word. There's no need to justify the change. And if they did, I mean, they could come up with it somehow, right? You can make any story you want sound good. So just be aware. Let's do it in reverse. Let's say they've wooed the major account. They've gotten them 20, 25% on Apple. And now they're saying the family or the account is saying, hey, I'd like to take profits on that. So they then make sure the brokerage then says, well, hey, this account, we use Apple. Apple's truly a strong buy. They move it from buy to strong buy, and they start pitching it as, hey, this stock is, about to announce a new product or is selling more than they thought. We think they're going to beat earnings, blah, blah, blah. And so everybody starts jumping into it. Said, oh my God, the brokerage is looking out for me. It's time to get into Apple. So you pour your money as a bunch of sheeple. We pour our money into Apple. The price then jumps even further, and they sell, right? The major account then takes all the profit out, and there's a major sell orders coming in, which does what? It dumps the price of the stock, and you're the one holding it. Okay? So that is the myth. I'll probably get murdered for saying this, okay? But that is the myth of buy and sell recommendations from big brokerage houses. It's usually the opposite when they're trying to woo or get a major account the profitability they promised them. Ouch, right? You didn't read that in the Wall Street Journal, did you? So I have those scars, and many people do. So be aware when big entities start recommending what to buy and sell, because it's most likely not for your benefit. So if I end up having a car accident in the next few days, you'll know why. You knew this shit was going on, right? You could feel it, right? You can feel it that the world takes care of itself at the upper end at our expense. What did George Carlin say? It's a giant club and you ain't in it. Neither am I. I don't play at that level. All right, guys, we got one more thing to cover in this, and that's price to earnings ratio, the PE ratio. It's one thing to be aware of, and it's a great indicator of, is the market experiencing exuberance or Or are they over punishing a company on its stock price? Price to earnings ratio means essentially how many years of earnings does it take to match the price of the stock. And you'll see PEs of 10 and 20, and you'll see PE ratios of 100. So somebody said, hey, I'm willing to buy a stock at a price that it would take 100 years of earnings to justify that price. I think that's insane, but there are people who do it. And then some people say, well, I want 1-to-1, and I don't think that exists. So we're going to take a look at PE ratios for a minute. There are PE ratios of markets and PEO ratios of individual companies. Both are important. Because one of the things, like Warren Buffett will talk about quite a bit, is when the PE ratio of the S&P 500, meaning all 500 companies, when that is over, when the PE is too high, it means there's too much market exuberance. The market is probably setting itself up for a pullback. And then you rip it apart and you pull the company you're interested in out and you look at their PE ratio. The term, the delingoing here is a rising tide floats all boats or raises all boats, right? And so if the PE ratio of a market is going up, it's probably a good bet that the companies in that are also going to come with it. But the opposite occurs too. If the PE ratio gets too high and people get frightened and they just come out of the market for a while, the stock price will go with it. So if you're a long-term buyer of individual stocks, this is less important, but the concept we're looking for is a strong or good entry point, right? Even if you found the right stock, you need to decide, is it at the right entry point? Okay? So that's the second part of these individual investings. You can dollar cost average in, just like I taught you in the prior ones. Maybe that's the right way to go, but you don't want to get into a market if it's crazy overvalued, and you don't want to buy a stock if it's crazy overvalued, because it could correct and take several years and you just entered at the wrong time. So we're going to go to the screens. I'm going to show you a couple of PE ratios and then we'll be done. Okay guys, this is the PE ratio of the S&P 500 as a total index, right? We talked about buying ETFs that model or mirror the S&P 500, the spiders or the SPX. So this goes way back. I mean, God, this goes back 1800, 1874, 1871 is the first year. You can see it trundles along, and then 1980s is kind of when more and more people, the creation of 401ks and things most people didn't play in individual stocks back in these days, right? It just didn't happen much. It's kind of interesting. If you look at the Depression era, it didn't change the S&P that much. And then you get all the way in here, 1980 is considered sort of the beginning of 401ks and pushing individuals into the stock market. And so you can see the market begins, really, the PEO takes off. And then 2001 was one of the higher peaks. And then you look at 2009, 119. People were getting into the stock market with a PEO ratio of 119. And it didn't last very long. But to me, that's insane. And I find it interesting that was right in the crash. 2008, 2009 was right in the crash. And so I don't know why people were in the middle of the biggest, really almost depression. It was pushing a lot of money into the market, and I guess they were maybe getting money out of their real estate holdings and pushing it into the market. And my God, I mean, if you put money in that time frame and it fell back to, it's 13, 14, that's pretty nuts. Now you can see today it continues on up, and we got a spike back in 2020. This is just before the COVID crash. So this is September of 2020. I'm sorry, it's really just after it. And so I think what happened is the market took a major crash in March of 20. And over the next 6 months, people started reinvesting in the market and pushed it up. Today it's at 27.88. All right. So high, but not crazy. And you can see in general from 1980 to today is generally in an upslope. Right? You got to cut these extremes off. So you can see the market is not extreme, even though it's hitting the highest. We're setting all-time highs, and it's still the PE ratio of the market itself is not too crazy. So that's the S&P 500. Okay, and here's the NASDAQ. So it's another, this is the market level PE ratio. How overbought, how over enthusiastic are people with the NASDAQ? And you can see it really is pretty moderate, 26 times earnings. So the average PE ratio for all the stocks in the NASDAQ is 26.79. That's really not crazy when you look at it with historical comparisons. So you could draw the conclusion that neither the S&P 500 nor the NASDAQ are telling you that there's an over exuberance in buying into these markets. I don't know if that's true or not, but that is what the historical analysis of today's number is telling us. All right, guys, here's Apple. Charts either excite you or bore the hell out of you, so I'm just going to do one. So this is Apple, and this is a 5-year history of Apple's PE ratio. And you can see, again, kind of along with the markets, it's not crazy. I lied. I'm going to do second chart. Here's Amazon's PE ratio. I have no idea what happened here. But you can see it's currently at 61.46. So it's a much higher PE ratio than Apple, which is generally considered, I don't know if that's bad or good, but 61 is pretty high. But historically, it's really not much higher, and in fact, a fair bit lower. So although I don't like the 61.46, my opinion doesn't matter because historical averages tell me it's not crazy at that valuation. All right, guys. Well, if you made it this far, congratulations. Another marathon session. It's already 50 minutes. This may be my longest video ever. I don't know. It's single topic. I didn't know how to break it up. It's I don't know. It's a series you can get. We're talking about your money. We're talking about your ability to retire. You can make so much money doing this, and you can lose so much money doing this. All right. So the other thing we talk about getting our opinions out of here and our emotions out of here. And this is a classic example of buy low, sell high. You do that by getting rid of your FOMO, your fear of missing out, right? So you don't panic out of stocks when they start decreasing in value. You don't panic into stocks because you're going to fear you're going to miss out, right? You have a methodical plan for why you pick the stock. You have a good entry point for it. You methodically, probably dollar cost average into the stock, and then let it work, right? Let your system go to work. Don't fear out of it just because the market turns on you or somebody recommends you get out. So now if we have an economic crash, that may impact it, but those are pretty rare. Guys, I hope this thing helps. I hope this thing lands. I apologize for the length. I don't know how to do it any other way. And that's it. We'll talk to you guys later. Bye.